Hey everyone, welcome to the first official podcast episode of CryptoSetups. And I am excited to have with us Rupert and Jimmy from Amulet. Now, welcome to the show, guys, the first official podcast. Now, why I'm really excited about this, as I was telling you guys, is we're going to talk about your protocol, which is related to insurance. And I happen to have spent 20 years of my life in traditional insurance working and until I transitioned into crypto. So to launch this podcast and the first episode to be about insurance is ironic, I think. But so, welcome to the show, guys. And look, let's kick things off. Tell us who you are and tell us a bit about your protocol.
Well, first off, thanks very much for having us on. It's great to be the inaugural protocol on your show. That's quite a big accolade. So I'm hoping things are going to go up from here, and that's going to be really worthwhile. Is there an NFT being made of this one?
Well, we could.
So yeah, look, we are Amulet. We're a brand new DeFi insurance protocol in the space. We came out of stealth around about 3 months ago or so now. Mm-hmm. And we announced the end of our first round of fundraising as well. We are built on the Solana chain. We're built for the Rust ecosystem specifically. So we're the first DeFi insurance platform on Solana. And as we expand and as we go more towards our multi-chain vision, we'll be going across alternative Rust-based chains in the future as well.
Okay, cool. And so currently we've got a few other players with on the block as well, right? InsureAce and so look, I think what I wanted to do was I wanted to kick off and because DeFi insurance is a little bit different compared to traditional insurance. So, but I want to make comparisons and then talk through how it's different and how you raise your liquidity and things like that you need to support, offering insurance in case there's claims that need to be paid out. So, first things first, let's break down some traditional insurance pieces. So, I want to keep it simple. So, in traditional insurance, how would they determine how much the company can take on as insurance, how a premium's used, and what do they raise and use their capital for? So just a bit of a summary around that, and then we'll go into what you do differently for Web3 DeFi.
Sure, no worries. Well, I'm going to pass over to Jimmy to this. Why don't you give a bit of background on you and then answer the...
I should probably do that. So they typically hire people like me. So I'm an actuary by training, worked at one of the largest actuarial consulting firms for about 6.5, 7 years. So doing stuff like investment strategy, ALM, stochastic analysis, stuff like that. Very traditional actuarial work. And the function of our job is basically to price risk, right? To say, over the course of 1,000 different policies, we expect one accident to happen. Mm-hmm. That one accident should result in $1 million claim, right? And we should expect that to happen, that one accident once in 1 year, right? So it's backed up by a lot of historical data. And then what they do is in the background, you also make some sort of a forecast for how that trend will change over time. Right. So maybe that one claim turns into 2 claims in the future. Right. So it's looking at a bunch of different signals to really determine how severe the claim will be. Right. That's the $1 million and how frequently it'll happen. But actuarial science and actuaries are kind of working in the background to look at large data sets and to really help price that risk.
Okay, cool. So then now when you look at traditional finance versus Web3, what are the key challenges faced in the world of Web3 insurance?
So, I mean, one of the core things, when I look at it from our standpoint, is really the amount of data and the history existing around some of the products that we're designing and building for. Mm. So one of the huge advantages that we have is that all that data's on chain, right? We know when people have been hacked. We know when people where the money transfers go to. We can follow that, and there's a lot of people that are very keen inside the space to follow that right down to the nth degree. The downside is that we were super young in the industry, and trying to build out risk profiles and models against that is still very, very complicated. And there is an element of us having to lean on traditional Web 2 cyber insurance and those sorts of areas in order to build out the rest of our kind of our piece or our background knowledge to each product. Was that fair to say?
Yeah. So the data issue is definitely one piece. But in fact, like I've been talking to like some experts in like the cyber insurance like space, and even though there's a lot of like instances of like cyber insurance hacks, they have a lot of incomplete data, right? So despite the fact that like we're really, really early on, and like we don't have a lot of data, the data that we do have is decently robust. And shout out to folks like DeFi Yield app, Rect. They're like doing a really good job of like collecting like all of this data, and publishing it to the general public. And then the auditors themselves, a lot of them have like pretty good tracking and lots of tools to detect like the hacks as they occur. And there's generally the ability to like come to a consensus on like what was the exploit, was it malicious, and could it have been perpetrated by like insider parties. So data is definitely an interesting piece and an interesting challenge. But as we start to like see this space mature, and just as time passes, like we're going to get better and better data, and that's going to allow us to train the models more efficiently, allows us to price things better, as you would know, and then that leads to just more products, more capital flowing into the space. And with more capital flowing into the space, more brains flowing into the space. And so eventually I think we'll hit a space where we're really going to get a lot of builders who can build their own like insurance products, right? Right now it's concentrated to a very few limited companies and limited folks with like very specialized like skill sets like actuaries in the background. But what happens if I just want to set up a market sometime in the future, right? Like I want to insure against my I don't know, that I don't choke on this unsweetened green tea or something like that, right? I don't know, that's a completely random example, but like it's just the ability for anybody to come up with like their own like insurance product. That'd be pretty cool. And you can do that all on chain, and you can kind of gather the data and the signals, right? As long as the signals are available, like you can pull them and you can price them.
Yeah, it's interesting what you're saying, because we are very new and we're discovering what we want insurance for in DeFi, right? So we've got your smart contract vulnerability, but we're so new. And at the same time, though, what we know, we can get a ton of data around, which is what you need in traditional insurance and stuff to, as you described, kind of understand the risk factors and how much you can take on before you couldn't cover if there was an event. So the problem I see is, because it's so new, there's just things coming up that as much as you try to anticipate, you can't anticipate. But I guess that's what creates opportunity, right? Because I was looking through some articles and I noticed you're offering cover, and we'll get to that in a moment, on a few new areas that I hadn't seen in the DeFi sector, in Web3. So, okay, so that's a real good summary of everything. Now, what I wanted to ask was, because we do have some players on the block at the moment, and Amulet's doing something different, though, right? So, do we want to compare what traditionally has been happening in the DeFi space and what y'all are doing different?
Sure. So In short, insurance has been the same for sort of 300 plus years. Like ever since it's been created, it's been this two-sided marketplace where you've got people who stake, a lot of capital on one side, and people who take out policies on the other side. Now, this system works fine if one of two things is going on. A, there's no claims, and B, that one side, the staking side, is much colossally bigger than the amount of policies that you're selling on this side. But if you've got huge amounts of staked assets on the one side and you're only selling a few policies on the other side, your returns are very, very small. So in DeFi, we've got this issue where we've got smaller amounts of staked assets, and anything up to about 500 million of staked assets is a small amount in insurance world. I mean, from your business that staked assets are in the trillions of dollars, and yet we've got these exploits that are happening that mean that you're going to erode into that $500 million or so at quite a large amount. So when you have to pay out a claim, you've got this decision to make. Who are you going to disappoint? Is it going to be the stakers, or is it going to be the claimers? And we've seen this kind of issue play out last year, where there's some exploits on Cream Finance, for example, and some of the insurance providers that were doing those, they had difficulty making the balance correct between those stakers and those policy holders. So what we did that's different is we want to make everybody happy. So we take staked assets and we put those staked assets into a Solana proof of stake validator, which generates a yield. And it's that yield that we then use to pay out our claims.
Yep.
So what that means is that we're always trying to protect core staked assets and only use yield and other pools that we put to become a barrier in between the claim and the staked assets.
Yeah.
Now, what that means is that we're making our stakers happy because their primary collateral is protected, and as they gain yield, they reinvest that back into that. So it's growing over time, and it also makes your policyholders happy because they're confident that they're always going to be paid out. There's never that decision to be made. You're always going to get paid out, come what may. Yeah. And so, as long as it's a valid claim, I want to caveat.
Of course.
If it's a fraudulent claim, you're not going to get paid out. But the point I'm trying to make is that we've fixed the system, and that fix has only been enabled by the technology that we're running on, right?
Yep.
So we've not been able to do that until proof of stake has been around, or a safer way to generate yield, should I point out. And so because we now have a safe way of generating yield, this is how we're able to operate the system. And that's why Amulet is simply different and in my view better, but I'm slightly biased to all other insurance products and protocols out there.
So and this is where I want to make the distinction. The current DeFi insurance protocols, they need liquidity, so they'll give someone a token of the protocol, for example, and say, "Yep, lock your liquidity, different tokens, Ethereum, BNB, etc., and we'll give you this much % in yield," which is basically the token inflating to provide to capture this liquidity. That liquidity is basically the amount of money the company has in the background to ensure that in an event, there's money to pay out claims, right? So this is where you made that comparison. Is it's at some point someone is going to get disappointed because the stakers are getting that high yield, but if there is an event, which we have seen transpired with the famous UST depegging, so what y'all have done is kind of, and now this is a bad comparison, but I mean it in a real good way. What you've done is kind of done what Anchor was trying to do, right? Where it used the proof. I know, but this is what I mean.
I mean, when you say bad comparisons, I mean you could have picked a better.
I know, but fundamentally,
podcast we're doing.
Well, it is insurance, and fundamentally, Anchor revolved around this process. Forget them topping up the yield. The yield was always using the proof of stake assets, which is exactly what y'all are doing, right? So I know terrible comparison, but over here, what?
In fairness to Anchor, I believe their protocol is still operational and running and still provides a 20% yield. It's just the assets themselves are not worth anything now. So we're not. It's not necessarily apples with apples. Yeah.
No. It is just more about that. People could stake their asset, and what yield was being generated, the protocol took and paid out as interest. So what y'all are doing in insurance is doing the same thing in that way, where users can stake their assets, and you're just using the yield. So in this scenario, are you rewarding? So me, if I have my bags of Solana that I want to stake and put onto Amulet, will I get rewarded? What kind of rewards will I get apart from my yield?
Yeah, so primary is obviously your yield, but you also get rewards from our native token for the longer you stake for, the longer you lock up, the more of our native token that you'll get, which will obviously be launched at our TGE, which is a date still to be set, but it will be coming in the future. On top of that, we also do alternative protocol rewards. So the protocols that we work with, as an example, and again, these are not set in stone, but Orca or Radium or Solend, these are protocols that we are looking to ensure as we go live, and we would look to do cross pollination marketing techniques. So it's a benefit for them if you stake your capital and you focus some of that capital more towards them than other protocols on Amulet, and so that gives them greater capacity, which gives them greater user uptake, which gives them greater confidence and comfort for their users. So it's a real benefit for them, which is why they want to do token rewards back to our users because of that. And so there's multiple ways that we kind of reward people throughout the system. But one of the key things I wanted to point out is it's not just Sol that you can stake with us. You can actually stake other liquid staking tokens, including ST-Sol and M-Sol from Marinade and Lido, respectively. So we are, really embedded in that kind of Solana ecosystem, whereby if you're already staked in Marinade or Lido and you've got a whole bunch of ST-Sol and M-Sol and you don't really know what to do with that, or you haven't got any opportunities, then you can stake that with us and obtain more yield because of that.
Yeah. So, and in this scenario, so when they stake, the native asset yield is what gets taken by Amulet, and you're rewarding on top your native token. Cool. And I like to drill home this point because it is different. It is very different, and it's a great way because you're not. I like the fact as well that you're using native chain assets. I think that's a real call out and distinction as well, because as long as these chains exist, I'm going to throw some, say you use BNB or etc. As long as they're the native chains that have protocols running on it, there's always going to be demand for Sol, BNB things, Ethereum, etc. Because that's otherwise the dApps won't function. So I love it. I love that you're using that concept, and I know I use a terrible example, but at its core, that's what the yield was being used for, right? And you kind of adapted that model, and
it's a good way. A good example of it is like Lido or with Marinade, right? Both of those are liquid staking protocols. We have that same liquid staking functionality built into our platform. So you come in with Sol, you get AMT Sol back, and that is our liquid staking asset. But then we have the next step where you can stake that liquid asset into our AUWT token, and that is the core underwriting token for all of our policies. That's I suppose the step that Marinade and Lido are missing, because they're not insurance protocols.
Okay, well let's. Oh, Jimmy, did you want to say something?
Yeah, I was just going to say there's like multiple layers of returns, right?
Yeah.
But like you can really decide as a user like how much risk you want to take on, right? If you're just looking for really safe like base level returns, you take the AMT Sol. If you want some premium sharing and you want to like really participate in like getting like yield farming rewards from like all these other protocols, take the next step and like underwrite like some insurance. And you can choose, right? You can, quite frankly, you can choose like which policies, like, and which protocols like you like to underwrite, right?
Okay.
And so like you can say like, you know what, like I'm getting paid, X percent, right? Like maybe like 5% on underwriting one particular protocol, and I think it's a good risk. I really understand it. I've done my research, so it's a way for you to almost make a bet, right? And you're getting paid to really protect that protocol. And so, yeah, really, like it really depends on like the user and like how much they want to like really jump into DeFi. But like on our one particular platform, you get to make that choice, right? And every single step, like you just choose like how far you want to go.
Okay, with their own risk profile. So
Exactly.
at its safest, you can literally stake what we were talking about before, and not worry about losing your capital. And then if you want more yield, okay, I didn't realize that. That's quite interesting. Okay.
Yeah. So one of the things that we've done really differently when we architected the system is that we realize there's different types of users out there. Like I'm a real stake and forget person, right? I want to put something in and literally forget about it and not think too hard about what I'm doing with it. Now, I think there's a whole bunch of other users out there like me. So we have an option for that where you come into Amulet, you stick your Sol in, and then that's it. That's all you need to think about. And what Amulet does is it balances it and creates a pool between the different protocols. Now, that's fine for that type of user, but there's the expert type of user as well who wants total control and total understanding of exactly what leverage they're putting at. And so those users can come and they stake it into AMT Sol, and then they take some of that AMT Sol and they'll put it somewhere else, and they'll take some of that AMT Sol and stake it back into AUWT. And then when you get into that layer, you can then decide exactly how much leverage you want on each individual protocol, and you can go wild with the kind of level of customization you want to do with your portfolio.
Okay, so this reminds me of the early implementation of Nexus Mutual, where the token you would literally go and pick the protocols you felt comfortable sticking the token on to earn you premiums and yield, etc.
Yeah, and actually, that's a very good association. It is very similar in that respect.
Yeah.
I think one of the major differences, if I remember correctly, I don't think you get to control the leverage on
there was never any leverage control yet.
That's one thing that we do very differently. Is you can say, I want to, give X amount of leverage to every dollar that I put into this platform. I want it to equal $10 of cover for them. Now, and of course, you'll get more yield because of that. But then there's much higher risk for doing so. And so that's a big difference between us and the original. I'm trying to remember what Nexus Mutual called it.
Shield mining.
Which one?
Shield mining.
Shield mining, I think they called it. Yeah. But in short, that's not a bad analogy. I think the biggest difference is that we've got both. Yeah, you can do that if you want to go into that level of detail. You can. If you just want the simple, easy stake and forget.
Yeah. No, that's awesome. Okay, now we've been tackling that for a little while. I want to step back and go, let's talk about what kind of cover you're going to offer. So what can me as a user get insurance on?
What do you want, Fez? We'll design it just for you. So yeah, typically, we're doing the bread and butter pieces that a lot of the other folks in the industry are doing. So we're doing smart contract risk and stablecoin depeg. Now, as you've already touched upon, stablecoins never depeg, so that's
Never heard of it. Impossible.
We've got a great use case, obviously, for the reasoning behind that. But actually, funnily enough, when we were out there in November and we were talking about stablecoin depeg as one of the products that we were offering, people were genuinely saying that never happens. What are you talking about? But we knew that this was a risk, and unfortunately, actually, it has been shown. Anyway, so those are the two main products that we're doing, and that's what when we launch in September. That's what we're pushing off the bat with those particular products. Now, as we go forward, though, we're looking at much more broad range of products, including I think probably my favorite is GameFi. So when we look at the rise of GameFi now, we're looking at the potential of big losses for gamers inside games, and these losses, may only be $20 or $30 a time, but that's actually quite a lot for an individual gamer. And so, let's say in game A, you have to buy a sword to get much further along, or it gives you some sort of power up, or this and the other. But that sword can be taken away. That sword can be attacked. It can be damaged. That's where we come in, and we want to be providing the insurance around that, so that once you're in the game and you're buying that game, you can literally tick the box and say, yes, I want insurance, and it just purchases it right there and then inside the game. That's where we see the big expansion. And on that note, that's one of our reasons for being on Solana, so that we can do these high transaction rates, very small values, and not be hit by these massive gas fees.
Okay. No, I hadn't. I wasn't aware of this. The GameFi side. So, in terms of what are you? What will you be insuring there? Is it so? In this example, you got the item. Is it more? Say in the game, it could get broken or it loses value, perhaps as well.
Theft, damage, losing value. I think it'll be really interesting. To experiment with, because you might see users change behavior as well. We don't know whether that will be for the better or for the worse, right? Because if it's insured, then you'll also say, oh, screw it. I don't care about this. I'm just gonna go balls deep into this raid, and I don't care if I lose my assets because I'm insured, right? So there's maybe that enables you to be a little bit more degen, even while you're gaming.
That's what we need. More degens.
Yeah, maybe, right? Or you could get people who decide, oh, hey, I'm going to put zero effort into this, and I'm just going to try and game the insurance company, right? I'm just gonna keep buying insurance, and let's see if we can squeeze out dollars from the insurer. So be aware, I'm watching you, thinking about how you think, and that it's always going to be a game of cat and mouse, and can we design some sort of a product that helps users and kind of also prevents fraud, right? So we need to be very very careful about that, but super bullish on prospects, because in the traditional world, folks are able to protect their property, protect their assets, right? Why can't you do that online and on chain, right? That's kind of the question that we're trying to answer.
So this is one of those scenarios earlier you touched on, where having the data, but now this is a new area where the data may be there, but you just don't know. No one's actually used it or thought that way, as you said. No one's thought about, if I had insurance, could I just Leroy Jenkins it and
Leroy?
Yeah, exactly. So that's interesting. So do you have a protocol in mind where you're going to test, or am I squeezing you for too many?
That you're you trying to ruin us as an insurance protocol.
He's asking for the alpha.
He's asking for me.
Alpha. Not ruin.
We are working with a with a few different protocols on our smart contract risk and on the GameFi as well, actually. With GameFi, we're having to go game by game. And essentially, there is no one thing that fits all. And we're working, and also all the games that we want to work with are big AAA titles that are out typically in Q1 next year. So we've got a little bit of time before those things actually come through to fruition. As I mentioned before, the September launch for us, we're working with a number of different protocols. I can't say exactly.
I was more interested in the GameFi. I was curious on to get an idea of what type.
Yeah, there's no expectations, but there's a few, and I can tell you the alpha offline.
Okay.
Of who we're looking at.
Oh, good. Oh,
everything on chain. What are you doing?
well, on that, okay. On a separate note, how you said a lot of them are started next year. So when you approach some of the builders around this integrating, because what you said is essentially trying to integrate your insurance when they get the item, etc. So it's a tick of a button. How have they been receptive to it? Does it add a layer of complication for them?
So actually, the most of those interactions have been the other way around. So they've been coming to us.
Oh wow! Okay, that's great.
So this is the interesting thing. First off, I never grew up wanting to sell insurance. Surprisingly enough, I didn't. At 6 years old, I never knew that this is what I wanted to do. But oh my god, I absolutely adore it. I love it, and it's just, I found my chi. But and one of the things that is so interesting about Amulet is that we have all of this inbound connections. So it's not like through the Solana ecosystem. When you kind of post a project, there's you get quite a lot of natural connections that come through to your email address. That could be from VCs and other people that want to know more about your project and this and the other. But actually, from just attending things like Solana Hacker House and Solana Ventures are connecting us to a few different people. Those that they turn into these inbound requests of people just wanting huge amounts of cover, and so far we haven't really needed to push our protocol or what we're doing really hard because we've had all of this inbound sales pressure. So the pressure on us is just like get the product out there as quickly as possible. And make sure it's safe. And that's where we're at right now. We're actually in smart contract audit as we speak, and wanted to get it out there. But the conversations have been really interesting. When you talk to the GameFi folks, they're like, oh, that's something we've not really thought about. And that's clearly going to be a bit of an issue for some of our people. And they didn't realize it was even possible. And then when we talk to like some of the regular kind of DeFi protocols, they're like, we just want to protect everybody. We've seen so many people be damaged. Our audits are only so good. Our smart contracts are only so good. There are things that we can't see in our blind spots, and that's why we want to protect everybody inside the protocol.
I think that's a really good point too, where like even some of like the top audit firms, like they'll say like, yeah, we've checked the code, but can we guarantee 100% that this thing will never be hacked, right? No one's going to say yes. There's no way to control for that, right? Somewhere, somehow, somebody is going to find like a way to break into your protocol. And so like, you just have to try and, guesstimate like, like what that is, right? And that's part of the fun here, right? Is like, can we try and price these like products like profitably? Can we try to do this in a really sustainable way that helps to like boost the entire Web3 ecosystem? That's the challenge, right? Like we want to do better. Like we want to make sure that the next 100 million users don't have to go through the same problems that like we went through as we're like using different protocols. Like why is it that like we keep getting rugged, right? Can we set some standards for like these protocols? Like I understand shipping is cool, but like, hey, how about like shipping sustainable projects, right? Let's try to set some like security standards. Let's try to set some standards that when it comes to token launch, when it comes to governance, right? And let's like try to help the entire like lift the standards of like the entire ecosystem, and then let's also like try to tack on like insurance on top of that, just in case, like if you've kind of followed all of these different procedures and you still find yourself like getting hacked, like someone's there. It's kind of the last piece of decentralizing like institutional power, right? The reason why like a lot of institutions have like this branding power is because they know that like at the end of the day, like a customer like trusts them to like make them whole, or at least there's the thought that they'll make them whole if something goes wrong. So if we can provide insurance like for a lot of these like different projects, we really think that like we can lift up like the entire industry, or at least like be one small piece of that.
No, okay. So I think it's a good call out. It's so important that there's no. It's like in Bankless, the podcast. I always say the Wild Wild West. It really is a Wild Wild West. Everyone's just kind of shipping or deploying with no. Some protocols now have started to take the time to make sure that they're putting due process, but there's no reflecting. Oh, these are the things that have happened. Have we protected our protocol against all of this? And it comes back also to this. We're in such a new space that. What you said, some things we just hadn't envisioned that, you could do that and it would cause this. No, and these are things that kind of happen and have an impact in our industry. But so far we've talked about everything. I think ultimately one of the things we need to cover is claiming, right? At the end of the day, people are getting insurance because in an event of a claim, something happens, they want to be able to claim and get reimbursed. In traditional insurance, the claim process can be quite long, tedious at times, so some of it can be quite quick because it's bread and butter. This is what happened, you're at fault, this is how the payout will work, you have this much time to claim. Do you want to talk about Amulet, the claim process, in an event of a claim, how it would work, kind of timeframes and DeFi, how it's a bit different to traditional insurance?
Yeah, for sure. So in short, we try and automate everything that's possible, and some things are more automatable than others. And so if we look at our stablecoin DPEG insurance, that is an automated claim process insofar that we monitor through multiple different oracles whether or not the coin has in fact depegged, and if that then triggers the smart contracts that we put in place, and then as and when that does happen, it triggers off our claims process, which builds out basically a book of who needs being paid out and how much. And then we have one final tick box on our side to say, yes, okay, this has depegged. We've checked it out. Pay these all out. And so that is an automated process where the final human say so. And we put that human say so in there just because this will be the first time that we've run a system like this before. We want to be able to make sure that we can control it, that it can't be hacked by anybody else, or the oracles can't be hacked and that sort of stuff. So there does need to be that sort of fail-safe element in there. Otherwise, it will be, after we've done this a few times in the future, it will be fully automated the whole way from end to end.
Okay.
When you look at something like smart contract risk, that's slightly more complicated because the user has to submit the claim and submit their claim materials we might ask for more claim materials around it into our platform. And when that happens, that information comes to us. Our team verifies the claim information, whether or not, in fact, the smart contract has been hacked, or the exploit that we're covering is covered with the contract, and we make a decision, yes or no, whether or not this claim can be paid out. That claim then goes to the community, and the community makes a decision, yes or no. Should this be paid out? If we're both in agreement, gets paid out. If we're both in disagreement, doesn't get paid out. If there is an imbalance of decision, we bring in a third-party DAO, and that DAO makes the final decision for us.
Okay.
But time frame wise, like obviously for like stablecoin DPEG, like we're talking maybe a day, 2 days, or something like that. But for like smart contract insurance could be longer, but like Rupert said, like we're always looking for like signals, right? Like, you have multiple different like auditors who are able to confirm like right when a hack happens, whether or not it has happened. Generally, I don't think they're going to collude, right? And like try to kind of game the system. Maybe they do some point in the future. Who knows? But there's other like on-chain signals like you kind of look at, right? Like if a user says they lost funds, right? But their funds look like they're in their wallet, maybe that's a lie, right? Was maybe if they did lose money, did they lose it in and around the same time that like the smart contracts got exposed, right? So there's different things like you can check for, but it's imperfect because we don't have enough data to say like this is exactly like what happens in a reentrancy attack or something like that, right? Like so the tools are being built. I think ultimately we want to get that down to, I don't know, maybe a day or 2 days, right? Like just as short as possible.
100%.
Start to automate things. But I think that for now we'll be still going by this community-based approach. But long-term vision, like you have to automate, and you have to make it less subjective, right? That's the ultimate goal. But you have to take learnings like along the way, and I think there's benefits to having like a manual process. Like you really dive deep into the details first. You kind of see like the edge cases. So start small, start slow, and then start to build things out and scale out and automate where you can.
Okay, no, cool. Excellent. So I think one other part we touched on, and I want to quickly ask, obviously you've mentioned multi-chain, etc., but at the moment the focus is Solana. Given the environment with a few, chain stops and Solend, I even heard you mention Solend, and what's just transpired in a couple of days. How are you all feeling? What are your thoughts processes around still deploying on that chain, etc.?
So, in short, we're still pretty bullish on Solana, and the reason we're so bullish on Solana is because we've seen our techs deploy incredible system onto it, and it's working, and it's great. But the other main reason is that it's still so early for this particular chain. So at this sort of time period frame with like Ethereum and other chains in the ecosystem, they were still being stopped by all sorts of different protocols being launched out. I mean, I remember when CryptoKitties was launched on Ethereum, and we went down for a few days, and then the DAO being launched, we went down. Like, everybody forgets this like so quickly, and I think part of that forgetfulness is because people that are in the industry now, most of them haven't lived through that, and like this is the first time, and like, oh my god, the chain's gone down, and oh my god, it's still so centralized, and oh my god, like all of these things like Ethereum lived through. And I have the same argument with a buddy of mine who's the Ethereum maxi, and he forgets. He literally has forgotten all of this as he sits there sipping his martinis on a yacht. But the point is, this is a very early time for the ecosystem. That being said, we are, first and foremost a business, and we do have to hedge our bets because of that. So our multi-chain solution is, yes, we believe there's a multi-chain future, and there'll be certain verticals like GameFi that will be much more on one chain than they will be on the other. So if we want to get GameFi involved, we've got to go towards those chains. But there's the other element of our focus, which goes like, well, we've got to be multi-chain because there are potential flaws in these very early protocols and layer ones and zeros that we're working on. So there is that element. But in short, we're still, but we're actually in the Solana offices right now in San Francisco, broadcasting to you. So there's nobody here, so we can say whatever we like. But and to caveat, there's nobody here because it's gone 6 here. And they're remodeling the office. So that's
it's nothing to do with the bear markets.
No, it's really genuinely not. I realize I'm just digging myself a hole there.
No, look, guys, that's been great. I feel I've learned a ton about the protocol and just in insurance and DeFi insurance itself. Is there anything that I haven't asked that you feel you want to touch on today?
He didn't ask when token and
when moon. He didn't ask when token.
I did.
When moon, when Lambo.
When moon, when Lambo.
I mean, that's a given. I expect you all to start with this.
So we came out of stealth, and I kid you not, you can look back on the Discord server to check this. But we came out of stealth. We advertised that we had the Discord server open, and people started coming in. And I think it was literally 5 minutes after the first user arrived, it was when token. And let us breathe for a second.
Yeah.
I think there's always so much expectation over when are you going to launch a token? And look, this is the way that we look at it. Caveat: we will launch a token. We have to launch a token. That our business is predicated on the fact that we will be doing that. So join the Discord and and follow us, and we're gonna really encourage everybody that is in the Discord from the early days that they're gonna be really well rewarded. But the biggest thing for us is that we have to have traction through it. I don't think gone are the days when you launch a token and you raise money off that token. We have raised money as a business already, and we're very we're able to operate at maximum efficiency with the capital that we've already raised.
Yeah.
We want to involve our community. Our token is a big part of how we operate as a business going forward. That's the reason for launching it, not because we need to raise a load more money now. Yeah. So it's also important to timing is massively important to our framework. So in short, we're gonna launch the token. And I think the dogs are very excited. They're super excited about this token. I mean, wow.
See?
They're going all over the place.
She's saying when moon.
When moon. So token first, then moon, then Lambo. That's the process that we like to work out.
Okay. So on that note, you mentioned the protocol is going through audits at the moment. When do you expect it to launch? The protocol.
September launch.
Okay.
We are working very, very furiously to that date. We're desperate to get it out there, but equally, we want to do it right. We don't want to have any leaky holes in our smart contracts. We want a good working protocol and to launch it correctly.
Yeah. Okay, awesome. And look, one of the main reasons as well I had you on to learn about the protocol is I'm looking forward to actually creating some tutorials around it on how to show users how to actually take out insurance. So I'm excited to play around and hound you with 100 questions on how things work so that I relay the information correctly when the time comes. So look, Rupert, Jimmy, thank you so much for coming on the show. Is there any closing words? Cross-check. I can see Jimmy's just itching to give me some alpha. He's like, we didn't give him any alpha.
What was your closing words on that? Now you're on the spot.
My lips are sealed.
Yeah. No closing words
Cool.
from.
There kind of is. So like one thing that like is not apparent in the light paper, and we certainly like don't touch on it at all, is like we also want to be this bridge between TradFi and DeFi. The conversations are underway. Let's say that. So that's the tiniest little bit of like alpha leak. So we have some aspirations, or some grander aspirations. Let's say that.
I'm going to just jump to a conclusion here, is that I can insure my car, my real world asset. I can just come onto your platform and go, yep, I'll pick this car, and insure. Oh, there we go. I'm getting the hands in the air, which essentially means that's what's happening. Okay, thanks.
Well, I think you need to put the next CryptoSetups meeting in the diary for like 2 years' time, and we'll see whether or not that.
Yeah, exactly. Called it. Look, guys, really appreciate you taking the time to come on the show. I look forward to when the protocol launches. I think, as you know, as I said, I worked in insurance. I think insurance in DeFi, with everything happening in Web3, is crucial, and I'm glad to see people and protocols coming in, taking time to build this, and as you said, take the time and experiment with things that we haven't, like GameFi. Hadn't even thought of that. Playing with it and seeing what's out there, what's the appetite for people to actually go, yes, this is something I want. We've got to be the pioneers in the space, right? So awesome work. Really looking forward to it. Can't wait to look at the protocol and show some steps on how to actually use it and take out insurance. Thank you for coming on the show, guys.
Awesome. Thank you.
Thanks for having us.
No worries. Take care.